Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Thursday everybody. As the developed world has spent much of the past 18 months struggling to control inflation, China is experiencing the opposite and arguably more serious problem of deflation. Yesterday, Wednesday, the National Bureau of Statistics released the official Consumer Price Index. According to the index, consumer prices dropped 0.3% in July from a year earlier, meaning, officially, China has slid into deflation. Its first time to do so since February 2021. A breakdown of the consumer inflation figures shows prices for household goods, food, and transport contracted, while prices of services spending like recreation and education climbed. Producer prices also fell for a 10th consecutive month, contracting 4.4% in July from a year earlier. Frankly, it is incredible that the National Bureau of Statistics even published these numbers showing a contraction in prices. Just last month, a National Bureau of Statistics spokesperson expressed at a press event, quote, "Deflation does not and will not exist in China," end quote. Thus, this is quite an about-face. With the release of the concerning numbers, the National Bureau of Statistics spokesperson expressed yesterday that the decline is only temporary and caused by the high base of comparison with last year, adding, quote, "The CPI is likely to rebound gradually," end quote. Analysts are less rosy in their outlook, however, pointing out that the country is facing a prolonged property market slump, as we saw yesterday, declining demand for exports, weak consumption, and rising debt levels. Without expertly managed government stimulus, it is hard to see a rebound anytime soon. Quote, "China is in deflation for sure. The question is how long? It's up to policymakers. They will react with coordinated fiscal and monetary easing. They need to accelerate all the government spending, raising government debt, coordinated monetary and fiscal easing to break this debt deflation trap," end quote. Others are a little bit more optimistic, however. Quote, "We expect CPI will be negative only for the short term, like for 1 or 2 months. Food and energy prices are more likely to go up instead of going down in the second half of the year. That means the drag on CPI seen in the first half from food and fuel will likely ease," end quote. And our often quoted Professor Pettis has quite the contrarian take on the situation too. Quote, "I'd say that China was in CPI deflation, that forbidden word, for most of this year. But that in July, for the first time since February, the CPI index actually rose. This doesn't prove that deflation is over. We need to see a few more months of increases, but it suggests that the news is not quite as bad as the many headlines propose. What is clear, however, is that the GDP deflator continues to be negative, and so China's debt to GDP ratio will rise even more this year than expected," end quote. When Pettis says that forbidden word in relation to deflation, he is perhaps being more than just a little tongue-in-cheek. This week, UK-based Financial Times published a story arguing that Beijing is putting pressure on prominent local economists to avoid discussing negative trends such as deflation. Multiple local brokerage analysts and researchers at leading universities, as well as state-run think tanks, the outlet writes, said that they had been instructed by regulators, their employers, and even domestic media outlets to avoid speaking negatively about topics ranging from fears of capital flight to softening prices. 7 well-regarded economists told the Financial Times that their employers had told them some topics were off-limits for public discussion. 2 think tank scholars and 2 brokerage economists, all of whom serve as government advisors, the outlet continues, said there was pressure to present economic news positively in order to increase public confidence. Quote, "You've got an economic slowdown that would worry any country, coupled with a China that always likes to put on a brave face to the world, and a leadership that is particularly image-conscious. Put those three factors together, and it's the recipe for a very non-transparent economy. End quote. One unnamed Chinese economist speaking to the Financial Times reportedly expressed, quote, "There was no problem talking about deflation or other economic risks last year. Now such comments won't appear on TV at all, even if I make them in pre-recorded interviews." End quote. But returning to the topic of the deflation numbers published yesterday, how will the government respond? We have already seen fiscal support this year, but as regular viewers know very well, the local fiscal crisis and very high existing leverage rates are making policymakers extremely hesitant to turn once again to this particular toolkit. The market also appears to be anticipating that the weak inflation data will prompt the People's Bank of China to add more monetary stimulus, like cutting interest rates. However, the central bank is concerned by the weakening yuan and elevated debt levels in the economy. There is another complication too: China's powerful banks. And on this point, next up, Chinese financial media outlet Caixin reports that the People's Bank of China's recent support for commercial lenders to reduce rates on existing residential mortgages has, quote, been met with foot-dragging from banks, despite the potential benefits that the cuts could offer China's faltering economic recovery. End quote. The People's Bank of China has been encouraging commercial lenders to renegotiate existing mortgages with homeowners or replace them with new ones. This is because the central bank is concerned about homeowners paying off older and thus more pricey mortgages too early. Citigroup Inc.'s chief China economist recently estimated that in 2022, 4.7 trillion yuan, $700 billion worth of mortgages, 12% of the year-end outstanding total, were paid off early in that year. We also remember from a People's Bank of China report published last week that China's outstanding residential mortgages experienced its first year-on-year drop on record at the end of the second quarter of this year. According to Fitch Ratings Inc., outstanding mortgages originated in China between 2018 through 2022 now carry an average interest rate of around 5%. This is higher than the current benchmark for mortgage rates, that is the 5-year national loan prime rate, which is 4.2%. Some analysts argue that rate cuts on existing mortgages could end up benefiting the economy as it takes some deleveraging pressure off households, boosting confidence and spending at such a critical time for the economy. Indeed, analysts with Zheshang Securities made this very point in a note just last week. What's the problem then? It's the same old economic issue. One man's debt is another man's asset. One man's debt payment, both interest and principal, is another man's income, and this second man is China's banking sector. Indeed, Chinese banks consider residential mortgages one of their highest quality assets. Lower rates could squeeze lenders' profits and put their balance sheets under stress, balance sheets which are already not particularly healthy, especially for lenders exposed to large property developers. During meetings with regulators, bankers have since last year voiced concerns about the hit to their profits from shrinking interest income due to rate cuts to existing mortgages. An unnamed source at Postal Savings Bank of China told Caixin, quote, "The problem is losses that banks are nursing from the current wave of early mortgage repayments are not as severe as those they would suffer if they lowered rates on existing mortgages." End quote. As the American economist Thomas Sowell once famously observed, often there are no solutions, only trade-offs. Next up, the US rolls out more restrictions on Chinese tech. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. And for the 50% of regular viewers who are not subscribed to China Update, if you do enjoy this sort of content and you'd like to be on top of it as it's released, maybe consider subscribing. Sharing this content with people who you think would also enjoy this sort of content is also a massive help and is one of the best ways to help the channel grow. And for anyone who can go the extra mile and help keep China Update financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Next up, yesterday, Wednesday, the White House further escalated its ongoing technology conflict with China by signing an executive order banning new American investment in key technology industries that could be used to enhance Beijing's military capabilities. The order prohibits venture capital and private equity firms from investing capital into Chinese ventures associated with semiconductors, quantum computers, and certain artificial intelligence applications. In a statement yesterday, the Treasury Department expressed, quote, "The Biden administration is committed to keeping America safe and defending America's national security through appropriately protecting technologies that are critical to the next generation of military innovation," end quote, adding that the controls are a, quote, "narrowly targeted action," end quote. However, it is unclear how much money will be affected by this move. US investors have already pulled back significantly over the past 2 years, with venture capital investment in China generally plunging from a high of $43.8 billion in Q4 of 2021 to $10.5 billion in the second quarter of this year, a 75% collapse. And this was driven by market moves, not by government directives. This executive order is the latest in a series of actions designed to limit Chinese access to advanced technology. U.S. National Security Advisor Jake Sullivan has called this U.S. approach a so-called small yard, high fence strategy. U.S. technology restrictions against China have been relatively bipartisan, though with this move several Republicans criticized the president's order as being too little. As regular viewers know, the US has actively been trying to coordinate this strategy with allies in Europe and Asia. While currently Japan's official position is that it does not intend to change legislation governing outbound Chinese investment, officials in the UK and Germany have expressed interests in looking into similar outbound investment restrictions. Of course, Beijing is not happy with the new US move, which will likely place yet more pressure on the already highly strained US-China relationship. On Thursday, China's Commerce Ministry expressed serious concern, saying the order, quote, "deviates from the principles of fair competition and the market economy that the US consistently advocates," end quote. A spokesperson for the Chinese embassy the same day said that the order, quote, "politicizes and weaponizes trade," end quote, adding that China reserves the right to retaliate. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Thursday, and I will see you all tomorrow.